Welcome to this second lecture of week 8. We will look at the following: approaches to budgeting, components of budgets, and uses of budgets. There are three approaches to budgeting. The first one is performance budgeting, which is a concept from the early 1900s. It was the first real attempt at addressing key shortcomings of traditional line item budgeting. Whereas line item budgeting operated on the basis of classifying expenditure by type, performance budgeting sought instead to classify expenditure by the activities for which it was needed. By classifying expenditures according to activities, performance budgeting provided a means with which to measure efficiency. The second approach is program budgeting and multi-year program budgeting. By the 1960s, budgeting reforms had moved the discipline away from performance budgeting, somewhat short-sighted focus on activities, and turned towards program budgeting, which in essence focused on entire programs and their objectives. As with performance budgeting, program budgeting is also consistent with the concept of management by objectives. Objectives are synonymous with programs, and the budgets set up to accomplish objectives are referred to as program budgets. The third approach is zero-based budgeting. As the name may suggest, zero-based budgeting justifies from scratch, for example, zero, all expenditure on the budget, as opposed to budgeting on the basis of prior approved amount and incremental adjustments such amounts. In practice, zero-based budgeting is actually not intended to start from scratch, as its name implies. Instead, zero-based budgeting calls for a matching of available budget revenue against all the proposed expenditure items on the budget. It allows managers to increase funding for some programs whilst simultaneously decreasing funding for less effective programs given a fixed amount of revenue. In the language of zero-based budgeting, the precise tools used to accomplish this feat are decision packages and decision units. The principal budget, sometimes also referred to as the master budget, is classified in two main categories, namely an operating budget and a capital budget. An operating budget is compiled for the short term and normally for a period of 1 year. This deals with the revenue and expenditure of a department's daily activities and therefore includes enterprise's sales budget, which represents the starting point of the trading budget. A capital budget forms the next main component of the principal budget. This second category of the principal budget is part of the long-term budget of an enterprise and gives substance to planning in respect to the acquisition of fixed assets for the enterprise as well as financing these assets. A manager would be hard pressed to find a more useful tool than budget, perhaps particularly in the public sector. The following are important applications of budget. Budget enforce honesty in financial transactions through accountability. They facilitate the maintenance of control. They also facilitate planning and the management of resources. They balance income with expenditure, and budget are a source of information which inform the public of what government intends to do. It is a plan. Budget are also reports which convey information on how efficiency and effectively government has done what it said it intended to do. Performance. Budget are finally policy statement informing the public of government priorities.